Warren Buffett, often called the Oracle of Omaha, stands as one of the most legendary investors the world has ever seen. Imagine this. If you had invested just $1,000 in his company, Berkshire Hathaway, back in 1965 when he took the helm, that modest sum could be worth over $30 million today. Sounds like something out of a fairy tale, right? But Buffett didn't rely on luck or magic. His success comes from a disciplined approach built on 7 timeless rules that anyone, yes, even you, can apply to investing or life. Stick with me until the end of this video because I'm going to break down these 7 rules and show you how to use them to make smarter financial decisions. Let's dive into rule number 1. Stay within your circle of competence. Buffett only puts his money into businesses he truly understands. He calls this his circle of competence. Take a company like Wrigley's Chewing Gum. Buffett knows people will still be chewing gum 10 or 20 years from now. The rise of the internet or new tech won't change that. He gets the business's economics, its brand power, and its competitive edge. So before you invest, ask yourself, can I explain how this company makes its money? Can I predict its future? If the answer's no, walk away. This rule keeps you grounded and stops you from chasing shiny trends like crypto or cutting-edge tech unless you've done your homework. Rule number 2, think like you're buying the entire company. When Buffett buys a stock, he doesn't just see a ticker symbol. He imagines owning the whole business. Let's say you're eyeing Coca-Cola, which has a market value of around $100 billion today. Buffett asks, if I had $100 billion, would I buy this company outright, based on the cash it'll generate over the next few decades? This mindset shifts your focus from short-term stock price swings to the business's long-term value. It's like buying a farm. You're not worried about what someone else will pay for it tomorrow. You care about the crops it'll produce for years. Rule number 3, seek value, not bargains. Early in his career, Buffett followed his mentor Ben Graham's strategy of buying cigar butt stocks, cheap, struggling companies with a bit of value left, like a discarded cigar with one puff remaining. He'd buy them dirt cheap, extract that last bit of value, and move on. But over time, he realized it's far better to buy outstanding businesses, like Apple or Geico, at fair prices than mediocre ones at rock-bottom prices. The lesson here, don't just hunt for cheap stocks. Look for companies with strong fundamentals, like consistent earnings or a durable brand, even if you pay a fair price. Rule number 4, don't let emotions drive your decisions. The stock market is a roller coaster of human emotions. Greed pushes prices up during bull markets, and fear sends them crashing during downturns. Buffett stays cool-headed. During the dot-com bubble, when tech stocks were soaring, everyone was jumping in. When they crashed, they fled in panic. Buffett didn't budge. He saw opportunities where others saw chaos. For example, in the 1960s, he bought American Express during a crisis when its stock tanked. He knew the company's brand and business were rock solid, and today it's a cornerstone of Berkshire's success. To apply this, ignore the market's mood swings. Focus on the business's fundamentals, not what the headlines are screaming. Rule number 5. The biggest mistakes are the ones you don't make. Buffett's greatest regrets aren't bad investments. They're the opportunities he passed up. Take Walmart in the 1980s. He understood its potential but didn't act, missing out on billions in gains. Another example? Google. He saw its dominance early but hesitated, costing Berkshire a fortune. These mistakes of omission hurt more than bad buys because they don't show up in your portfolio. They're invisible losses. Buffett says if you had a punch card with only 20 investment decisions for your entire life, you'd think twice before passing on a great opportunity. So when you find a business you understand and trust, don't let fear or indecision stop you. Rule number 6, always calculate intrinsic value. Intrinsic value is the core of Buffett's strategy. It's the total cash a business will generate over its lifetime, discounted back to today's dollars. Think of a stock like a bond. A bond spells out exactly what cash you'll get and when. Say, $1,000 in 10 years plus interest. Stocks don't come with that clarity, so you have to do the math yourself. When Buffett bought Coca-Cola in the 1980s, he estimated its future cash flows based on its global brand and predictable sales. If you can't estimate a company's future earnings with reasonable confidence, it's not worth your investment. This is why Buffett avoids businesses with uncertain futures, like many high-flying tech firms. Rule number 7, hold great businesses for life. Buffett doesn't sell his best companies no matter how big the offer. Take See's Candies, a Berkshire-owned business. If someone offered him 4 times its market value, he'd still say no. Why? Because exceptional businesses keep compounding value over time, like a snowball rolling downhill. He applies this to stocks, too. His holdings in Coca-Cola and American Express have been in Berkshire's portfolio for decades, growing steadily. The takeaway: if you own a fantastic business, don't let short-term profits tempt you to sell. Let it grow. Now let's talk about how Buffett puts these rules into action. When he's evaluating a company, he looks for a moat, something that protects it from competitors. Think of Coca-Cola's global brand or Apple's ecosystem. These moats make it hard for rivals to steal market share. He also examines the management. Are they honest? Do they reinvest profits wisely to grow the business? And most importantly, he compares the stock's price to its intrinsic value. If it's trading way above what it's worth, he waits patiently. Take Apple, for example. When Buffett started buying it in 2016, many thought it was overpriced, but he saw its loyal customer base, recurring revenue from services, and massive cash flow potential. Today, it's one of Berkshire's biggest winners. So how can you start using these rules in your own life? First, build your circle of competence. Pick an industry you're curious about, maybe retail or food, and study it deeply. Second, block out market noise. Don't buy a stock just because it's trending on social media or your friend made a quick profit. Third, be patient. Great investments take time to grow, just like a tree needs years to bear fruit. And fourth, learn to estimate intrinsic value. You can use tools like discounted cash flow models or even consult financial advisors to get started. Here's a question people often ask. How does Buffett stay so disciplined? He treats investing like a business decision, not a casino bet. When he bought Dairy Queen, he didn't just see a stock price. He saw a company with a strong brand, loyal customers, and predictable earnings. This focus keeps him grounded, even when the market is going wild. Another question: why doesn't Buffett diversify his portfolio like most investors? Conventional wisdom says to spread your money across dozens of stocks to reduce risk. Buffett disagrees. He believes if you truly understand a few great businesses, you don't need to own 50 stocks. His portfolio is concentrated in a handful of winners: Apple, Coca-Cola, American Express, because he trusts their long-term value. Diversification is fine if you're unsure, but when you know what you're doing, focus on your best ideas. Let's touch on one more insight from Buffett's approach. When he hires people for Berkshire's companies, he looks for three traits: intelligence, energy, and integrity. Without integrity, the first two can be dangerous. A smart, energetic person without ethics can cause chaos. This isn't just for business. It's a life lesson. Surround yourself with people who share your values. Buffett also admits his mistakes. He passed on Microsoft because it wasn't in his circle of competence, and he's fine with that. But when he missed Fannie Mae in the 1980s, despite understanding its potential, that stung. It cost Berkshire billions. The lesson? When you know a business is great and the price is right, act decisively. So what's the big picture here? Warren Buffett's success isn't about being the smartest person in the room. It's about discipline, patience, and sticking to these 7 rules. He doesn't try to predict the market or chase the latest fad. He buys businesses he understands, pays a fair price, and holds them for the long haul. You don't need to be a billionaire to follow his lead. Start small, apply these principles, and build your wealth over time. Here's how you can get started. Pick one company you're interested in. Maybe it's a brand you use every day, like Starbucks or Nike. Research its business model, estimate its intrinsic value, and see if it fits within your circle of competence. If you want to go deeper, read Buffett's annual letters to Berkshire shareholders. They're free online and packed with insights. Before we wrap up, let's recap the 7 rules. 1. Stay in your circle of competence. 2. Think like you're buying the whole business. 3. Seek value, not just bargains. 4. Ignore market emotions. 5. Avoid mistakes of omission. 6. Calculate intrinsic value. 7. Hold great businesses forever. These rules aren't just for investing. They're a blueprint for making smart, thoughtful decisions in life. Thanks for watching. If you found this valuable, give it a thumbs up. Hit that subscribe button and ring the bell for more investing tips. Drop a comment below and let me know which of these rules you're going to try first, or share a company you're researching. And if you want more content like this, check out our playlist on investing legends linked in the description. See you in the next video.